Welcome to Tech Money Madness, your daily U.S. stock market deep dive. It is April 2nd, 2026. I want you to imagine going to sleep and waking up to find that a surprise 3.5% toll booth has just been slapped right across the internet's busiest delivery highway.
Yeah, just pop it up overnight.
Exactly, overnight. Anyone moving goods on that road suddenly has to pay a premium no matter what they are selling. And today, Amazon essentially did just that to its third-party sellers across the U.S. and Canada.
Right, and the truly crazy part is that this sudden toll booth exists because of, well, an escalating war half a world away. It is a phenomenal example of how quickly a distant geopolitical shock recalibrates the cost of our daily lives.
It really is. And, that is our mission today, to cut through the noise of the April 2nd market session and explain exactly why the U.S. stock market delivered such a mixed kind of tug-of-war performance.
Because if you just glance at the top-line numbers, you might think today was a completely normal, slightly positive Tuesday.
I mean, the S&P 500 and the Nasdaq both posted modest gains. But if you lift the hood, the engine is definitely rattling.
Oh, absolutely. We saw a stark rotation of capital into small-cap stocks and just an absolute explosion in the energy sector.
To me, it looks like a giant financial seesaw. On one end, the broader indexes and tech are desperately trying to keep things balanced.
Right.
But on the other end, you have surging oil prices launching the energy sector into the stratosphere, which is threatening to throw the whole playground out of whack.
What's fascinating here is how this seemingly chaotic underlying movement, this wild divergence between sectors, is actually a highly logical reaction to a specific geopolitical shock.
Right. The market isn't just acting randomly here.
No, not at all. It is rapidly repricing risk. And to understand that repricing, we really have to look at the heaviest weight on your seesaw, which is the ongoing Iran war.
Okay, let's unpack this. The conflict is severely disrupting global supply chains. Because of that, Brent oil spot prices have reached their highest levels since the 2008 financial crisis.
Which is just a massive economic threshold to cross.
Huge. And if we zoom in domestically, U.S. oil prices spiked an astonishing 11% just today. This immediate surge followed a speech by Donald Trump that, from a strict market perspective, ignited fears among traders of further conflict escalation.
Right, and we are strictly looking at the market mechanics here. An 11% spike in a single day for our most foundational commodity is a seismic event.
Oh, wait, I have to push back here. We have all lived through oil spikes before, but hitting 2008 levels feels like a different beast. Does a shock this large fundamentally rewrite the inflation equation for the rest of the year?
That is the core tension of the day. If this is so devastating, you might ask why the broader market isn't in a full-blown panic.
Right, because the S&P still posted gains.
Exactly. And the broader market isn't panicking because large-cap companies often have complex financial hedges in place to delay the pain of an energy spike.
So they buy themselves time.
They do, but that delay is temporary. You have to look at energy not just as a distinct sector of the stock market, but as the base cost of literally everything else.
Yeah.
It acts as a universal, unavoidable tax on consumer spending and economic growth.
Because whether you are manufacturing a physical product or just shipping it.
Right, exactly.
Those foundational costs, like the diesel for the trucks, the fuel for the cargo ships, they skyrocket, which means that 11% domestic spike doesn't stay confined to the commodities trading floor.
Precisely. It immediately challenges the operating margins of virtually every business. And this brings us back to your opening scenario with Amazon.
The surprise toll booth.
Yes. They are implementing a 3.5% fuel and logistics surcharge for third-party sellers. Amazon is effectively serving as the transmission mechanism here, taking that global energy tax and injecting it directly into the domestic e-commerce ecosystem.
But let's look at how that actually functions. If Amazon is passing these increased operational costs onto their third-party sellers, those sellers are the ones taking the initial hit.
Right.
And knowing how thin the margins are for independent e-commerce sellers, they cannot simply absorb a 3.5% operating loss.
No, of course not.
They have to pass that new toll onto you and me when we click Buy Now at checkout. So Amazon protects its own profit and loss statement by essentially socializing the cost across its entire network.
You hit the nail on the head regarding the structural advantage here. Amazon is leveraging its massive scale. They look at the volatility of 2008 level crude oil and make a rapid defensive adjustment.
Yeah.
By passing the cost to third-party sellers, Amazon protects its core logistics empire. Smaller logistics networks or independent retailers, they might not have the leverage to force a surcharge like that without losing clients.
That makes total sense.
So we are witnessing macroeconomic uncertainty bleeding directly into microeconomic business decisions. A conflict in the Middle East disrupts oil, the commodities market reacts, and within days, the cost of buying a phone case or blender online ticks upward.
It is the real-time transmission of inflation.
Ex
And it shows how aggressively some companies are adapting. But while Amazon is flexing its logistical muscle to deflect macro pressures, we are seeing another titan stumble significantly on its own micro fundamentals.
Tesla.
Yeah, Tesla. They just suffered their steepest stock drop of 2026. This followed a highly disappointing deliveries report. And looking at the broader timeline in our sources, this isn't just a single bad quarter.
No, it caps a full year of declining deliveries.
Right, heavily driven by escalating competition from rivals in China. Here's where it gets really interesting. Let's fold in the day's market movers data because the divergence is undeniable here.
Go for it.
Tesla was the top loser today, actively dragging down the broader tech sector. Energy stocks, obviously, were the top gainers. And the most active high-volume trading of the session was entirely concentrated in energy names, Amazon, and major tech.
Which paints a very specific picture.
It does. So I want your perspective on this. Is this steep drop purely a Tesla problem due to their own specific supply chain and pricing strategy? Or is this the warning bell for a broader EV market problem now that China is flexing its competitive muscle globally?
The data suggests this is heavily leaning toward a structural, company-specific struggle for Tesla. Though, it certainly carries broader industry implications.
Well, so.
Well, if we contrast the two titans, Amazon is making a macro adjustment to external uncontrollable forces, like a geopolitical war. Tesla, however, is struggling with internal foundational challenges in an increasingly saturated market.
Right. For years, Tesla enjoyed the luxury of being the primary option for premium electric vehicles. They had the first mover advantage. They were the only game in town.
Yes, but now Chinese manufacturers are producing technologically advanced EVs at highly competitive price points. Tesla's declining deliveries indicate that their market share is actively eroding. They are transitioning from being a disruptive tech monopoly to being a traditional automaker fighting for inches in a crowded global lot. And the market is repricing their stock to reflect that new, harsher reality.
But the struggles of one hardware-heavy tech giant don't mean the entire sector is frozen. We are still seeing aggressive strategic maneuvering.
Definitely.
Our sources highlight that OpenAI just made an undisclosed acquisition of the popular tech podcast TBPN, and they are housing it inside their strategy organization.
That is a crucial data point. It proves that despite the chaotic market seesaw we are discussing, strategic M&A remains highly active for companies that aren't weighed down by physical supply chain bottlenecks.
Right, they don't have to worry about the cost of diesel.
Exactly. Tech companies with deep pockets and clear digital roadmaps are still buying assets and expanding their footprints, completely unbothered by the daily ticker tape. It highlights the decoupling of companies bound by physical constraints versus those operating in purely digital or intellectual spheres.
That is a great distinction, the physical versus the digital constraint. So we have explored the geopolitical energy shock, and we have navigated the boardrooms of Amazon, Tesla, and OpenAI.
Yeah.
But ultimately, all these corporate maneuvers land on the shoulders of the everyday worker. We need to figure out if the consumer base can actually withstand these rising corporate and energy pressures.
Which brings us to the labor data.
Exactly. The March jobs report drops this Friday. Current projections point to a gain of 59,000 jobs, with the overall unemployment rate expected to hold steady at 4.4%.
Which, historically speaking, indicates a relatively stable labor environment.
On paper, yes. But at the exact same time, over in the retail and service sector, Starbucks is rolling out bonuses for their baristas and expanding tipping options.
Right.
The sources explicitly note this is a turnaround effort focused on improving both the employee and the customer experience to boost sluggish sales.
Yeah, it's a major pivot.
So, what does this all mean? How do we square an economy that boasts a stable 4.4% unemployment rate with the reality that companies like Starbucks feel compelled to aggressively juice their compensation just to keep operations functioning and entice cautious consumers?
This raises an important question about the profound difference between simply having a job and possessing actual purchasing power.
Right.
On paper, 4.4% unemployment implies people have incomes. The macroeconomic headline looks fine, but the microeconomic reality at Starbucks tells a very different story.
Because they rely on discretionary spending.
Entirely. If their sales are sluggish, it strongly suggests their customers are feeling a financial squeeze and pulling back. They are skipping the extra $6 latte.
Yeah, that's the first thing to go.
Precisely. And why are they skipping it? We have to circle back to the energy shock and the transmission of inflation. Job gains are a positive metric, but they lose their impact if the inflation driven by that Brent crude spike is quietly eating up the value of those new paychecks.
That makes a lot of sense.
Furthermore, Starbucks offering bonuses and expanding tipping indicates that the labor market for reliable service workers is actually quite tight.
Oh,
The
interesting.
cost of living is rising, pressuring those workers to demand more compensation just to tread water.
Yeah.
So you have a workforce demanding higher baseline pay and a consumer base with less disposable income. That is a brutal squeeze for any retail business.
It is the stark difference between having a paycheck and having a paycheck that actually covers the bills when the cost of commuting, groceries, and, Amazon deliveries are all creeping up.
Exactly.
And as if navigating the threat of war, tech divergence, and a stressed labor market wasn't complex enough, we have to introduce the final layer of market chaos from today's sources.
The regulatory wildcards.
Government intervention. We have 4 distinct pieces of regulatory news today, pulling the market in entirely different directions.
The government is certainly proving to be a highly active participant in this cycle.
To say the least. First, the Trump administration is preparing new tariffs specifically targeting drug makers that haven't struck deals to lower U.S. drug prices.
Okay.
Second, the Commodity Futures Trading Commission, the CFTC, is actively suing the states of Arizona, Connecticut, and Illinois to maintain exclusive regulatory control over prediction markets.
Right.
Third, the Senate just advanced a funding deal for the Department of Homeland Security, which could finally end the shutdown that has been causing absolute chaos and massive delays in airports nationwide.
That's a big one.
And finally, Coinbase snagged conditional approval from the Office of the Controller of the Currency, the OCC, to operate as a trust bank, which is a major boost for their stablecoin business.
Wow.
Looking at all of this, crypto banking, airport security funding, state-level lawsuits, and pharmaceutical tariffs, how can any investor possibly price in this much regulatory whiplash?
Well, pricing it in perfectly is nearly impossible, which is exactly why we see an elevated risk premium in the market.
Right.
When investors cannot reliably model the future because the rules of the game might change overnight, they demand a higher potential return to take on that risk, or they rotate their capital into safer, more predictable assets.
Let's break down the mechanics of a few of these because they represent very different types of regulatory action. Let's start with the CFTC and the prediction markets. Why is a federal commission suing individual states over this?
It comes down to jurisdiction and the definition of a financial instrument. Prediction markets are platforms where users buy shares in the outcome of future events, everything from election results to economic data releases.
Okay.
Proponents argue they are highly accurate forecasting tools and legitimate ways to hedge risk. The states like Arizona, Connecticut, and Illinois might be looking to regulate or foster these markets locally.
But the federal government disagrees.
Strongly. The CFTC views these contracts essentially as derivatives or commodities trading, which falls strictly under their federal purview. They are suing to establish that these markets cannot operate in a regulatory gray area or be governed by a patchwork of state laws. It is a turf war over who controls the future of event-based hedging.
That makes sense. It is about establishing the boundaries of a new financial frontier. And then we have the Coinbase news, which feels like a completely different flavor of regulation. They received conditional approval to operate as a trust bank. How does that practically change their business?
It is a profound structural shift. Operating as a federally chartered trust bank means Coinbase is subject to incredibly stringent oversight regarding how they hold and manage assets.
Especially for stablecoins.
Right, exactly. A stablecoin is only as good as the reserves backing it. If Coinbase holds those reserves under a federal trust charter, it legally insulates those assets, providing a massive layer of security and legitimacy.
So it's a green light for bigger players.
Yes. It signals to institutional investors that this isn't just a Wild West crypto exchange, it is a regulated entity operating with the blessing of the OCC. It shows that while regulation can be disruptive, regulatory clarity can actually unlock immense value.
Meanwhile, the tariffs on drug makers represent the disruptive side of that coin. By imposing tariffs, you alter the fundamental supply curve.
Right.
Pharmaceutical companies will be forced to either absorb the cost of the tariff, renegotiate their domestic pricing, or try to pass the cost along. It injects a massive unknown into their forward-looking earnings.
And contrasted with all of that, the Senate advancing the funding deal for the Department of Homeland Security is a pure stabilizing force.
Ending the airport shutdown.
Exactly. Getting commerce, logistics, and human capital moving again smoothly, which is a desperate need for the travel and retail sectors.
So we have the government acting as a stabilizer in aviation, a disruptor in pharmaceuticals, a gatekeeper in prediction markets, and a validator in cryptocurrency.
It is exhausting just to map it all out.
It really is. We have covered an incredible amount of ground today, from the macro forces of a geopolitical war to the micro realities of a barista's paycheck.
If we connect this to the bigger picture, I think we can synthesize today's deep dive into three core, undeniable themes that define the current market architecture.
Let's hear them.
Theme number one is the universal energy toll. The conflict in Iran is not merely a passing geopolitical headline. It is the central engine of market anxiety.
Right.
When Brent crude reaches 2008 levels, it threatens to bake structural inflation back into the global system. This acts as an inescapable toll on both consumer wallets and corporate operating margins, forcing companies like Amazon into defensive postures.
Which naturally leads into the second theme.
Right. Theme number two is the splintering of big tech. We have to abandon the idea that the technology sector trades as a unified monolith. Today proved that companies are decoupling based on their physical world constraints versus their digital dominance.
Like we saw with Amazon versus Tesla.
Exactly. You have Amazon demonstrating operational agility and OpenAI aggressively expanding its digital footprint through acquisitions. In stark contrast, Tesla is suffering from acute physical world problems, supply chain realities, and intense manufacturing competition from China that is actively eroding their market share.
They share a sector label, but they are living in completely different economic realities.
Exactly. And the third theme, bringing it all together.
Yeah, what's the final piece?
The regulatory risk premium. Investors are attempting to navigate a minefield of unpredictable government interventions. Whether it is navigating new pharma tariffs, anticipating the outcome of federal turf wars over prediction markets, or waiting for clearance on crypto infrastructure, the government is proving to be a highly active wild card.
So capital is constantly shifting.
Yes, this uncertainty forces capital to constantly rotate, seeking safety and clarity in an otherwise opaque environment. When you combine the energy toll, the splintering of tech, and the regulatory risk premium, the chaotic seesaw of today's market makes perfect logical sense.
It is like stepping back from a confusing up-close mosaic and finally seeing the entire landscape. The underlying forces pulling the levers dictate everything else. Thank you for walking through this with me today.
It is always a pleasure to connect the dots. The macro events always, inevitably, find their way to our micro-realities.
And that leads me to a final thought I want to leave you with today, something to genuinely mull over as you navigate the rest of your week. We spent a lot of time analyzing Amazon today.
We did.
If a single geopolitical shock in the Middle East can force an absolute giant like Amazon to alter its fundamental fee structure and drop a surprise 3.5% toll booth on its sellers almost overnight,
Yeah.
how many other hidden tolls, subtle surcharges, and quiet price hikes are being baked into the broader economy right now? And will we only notice them when we are staring at our own receipts, long after the rules of the game have already changed? Keep a close eye on those margins.
Good advice.
That's all for today's deep dive. Stay curious, keep looking past the daily headlines, and we will catch you tomorrow for more market coverage on Tech Money Madness.